Welcome to Affluent Commercial Insights, a YouTube channel established with the sole purpose of bettering the lives of students who are doing complex modules and subjects, both at a tertiary and a secondary level. I will not dive deep into the introduction, for this is not a channel that prides itself on the introductions, but rather it prides itself on the quality tutorials that it will be providing. So if ever you want to have an understanding and a coverage of the modules that will be covered, I would urge you to go to the channel's description. That's where you will also find some of the modules that will be covered. Today we will kick it off with auditing. And now the question is, what is auditing? Auditing is an official inspection of a company's financial statements or account, typically by an independent body or an individual. We will kick it off with auditing. We are starting with the introduction of auditing, but we are not going to be utilizing the slides, for we have quite a number of slides at our disposal that we can actually cover or that we could actually follow. But we will not be doing that at the moment. What we will be doing is that I have already taken it. As I've already said, this is a channel that is established with bettering the lives of students. I've already written notes that we are actually going to be using. So right now, as we're about to begin, I would also urge you to gather whatever that you're going to need so that we can focus. So you might pause the video for a bit, gather all that you need, come back, including your study packs. Please don't allow your parents to rob you of them, so do get them. But back to the content or the matter at hand. We are dealing with auditing here, so we are going to be following this, and then we also have slides. And it is also important to also stipulate and say it now that not all points will be read out in this session. This is a session that is an overview of what auditing is, where we will be interlinking a plethora of chapters. We will be covering or linking all those different chapters and making auditing feel as an if it's accounting. Remember, it's all about making it understandable and not difficult, like how lectures often do it. So this is where we're going to be kicking it off. As I've already said, auditing is an official inspection of a company's financial statements or accounts. Now, this is where we start off. The need for auditing or a need for auditors. There are primary reasons that we are going to be focusing on. The first one is what? Is the split between ownership and management. That's the first reason where a lot of content will be covered, and actually majority of all the chapters, we will be summarizing them under this crucial point. For every single thing will have a cause and effect. Second, when all of this has been gathered, remember, auditing is what? I will redefine it again. Auditing is the official inspection of a company's financial statements to then produce an opinion at the end. So now, this means the second point will be about what? Confidence. To say the owners of the company, should they have confidence in the managers or the directors that they have appointed. Third, for the promotion of accountability, whether it may be in the public sector or also in that private company. So now the first one is, and we're going to start where a majority of our focus will be based on. The first point, the split between ownership and management. Then we read, the natural development of owner to manager running the business, where the people who own the company do not manage, created, I think I had a typing error there, a typo. Let me read it again. The natural development of owner to manager running the business, where the people who own the company do not manage them, created a gap. So now we have a scenario. The scenario is that here, you as the person who's watching, you have money, but you're not going to be running a company. Rather, you're going to appoint someone to actually manage and run the company for you. So the person will be involved in the day-to-day businesses. You are not going to be involved in that, meaning that you are going to lack information. So there will always be a gap between the owner and the manager. So now this gap caters for a lot of things. It could be corruption, financial misstatements, or material misstatements. So now the solution to this gap was to appoint an independent person who's going to do evaluation, to evaluate the reports made by the managers, to then provide an opinion to you as the intended user or the owner of the company. So I am going to be speaking to you as the owner, and then you are also going to be thinking of directors. So when I'm going to be speaking, do actually put yourself in the shoes of an owner, and you will tell me how it feels then to be a boss or the owner of a company. So jokes aside, let's go back. The evaluation of those financial reports is called audit. For audit is defined as an official inspection of an organization's account, typically by an independent body. So here, as I've already defined what audit is, and then the person who's going to be performing that audit will be an auditor who's coming to close in the gap that is created by the split between the ownership and management. So we then move to say, okay, because of this, we need someone who's going to come back and evaluate this financial statements or the accounts of the organization. And then that person will provide an opinion after having to have done an examination of the financial statements to then produce an opinion. So this person will be regarded as an auditor, and an auditor is an independent personnel who is going to do an official inspection of a company's financial statements, who is registered with an independent body. Why is it important for me to outline that or to accentuate that? I'm now interlinking what audit is with auditor and also the independent body. The independent body referred to as an accounting body. We are referring to your SICAs, so on, that we are going to be covering now, meaning that we are now going to be linking chapter 2. Chapter 2. This is our chapter 2. Sorry, let me widen this. This is our chapter 2, where we are going to be looking. So the accounting body that the person will be under will be the one responsible for providing things like your professional code of conduct. To say this person, for we need also as a company to say we must have someone that could be held accountable by a certain body, to say this person, we might not, for remember there is a gap where the owner is afraid of material misstatement, falsification, corruption, and so on. But it is also important to note, remember that auditing is not actually initiated with the intentions of detecting fraud, but rather it is initiated with the intentions of ensuring that the company is following and it's complying with the recommended and prescribed financial reporting framework standards. So the person will be appointed. So as I've already linked, what auditing is, I've already defined it. I've defined what an auditor is, and an auditor should be registered with a professional body or an independent body, which is an accounting body. You'll come across it regarded as an accounting body or accounting bodies. The one that we will be most focusing on, or that is known, not in South Africa, not in Africa, but on a global scale, because accounting, South Africa is ranking number 1 under the body called SICA. So you should do research, and also you should also enroll in universities that are SICA registered. But also, if ever you are not, it's not a train smash. We will also cover that if ever we need, people are going to need advice. So the person who's going to be performing this audit, which is the accounting, the auditor who's registered under a professional body, will have these things which we call fundamental principle of psycha, which are what we're going to be covering the code of conduct. The person will need to have what? Integrity, objectivity, professional competency, and due care. Confidentiality. The person who's going to be supervising or examining the financial statements or inspecting them must not disclose this information which is obtained due to the profession and the title awarded by the body. For now, when we talk about accountability, we're saying that when the person is registered under a professional body, they could be what? There's credibility to the person and accountability for the person, not the managers. Remember, your concern will be two. It is the accountant to say, is he qualified? The auditor is going to come to perform. Is he qualified? Is he regulated? Is he going to be held accountable if ever he's going to do any criminal activity in line or in assisting the managers who might be doing material misstatement or corruption in the company? So this person will need to have a professional behavior. He must not associate himself with anything that should jeopardize the reputation of psycha or the professional accounting body that he is registered under. So we will be covering things like what? Integrity. We will also be covering objectivity. So when we talk about integrity, you see, we're talking about a professional accountant shall comply with the principles of integrity, which requires it requires what? A person to be honest, truthful. So when we're talking about integrity, these are the points that you must outline. Most important, they must be honest, fair dealing, meaning that they must not be persuaded to falsify or provide opinions that do not reflect the actual representation of the financial statements and the compliance of the company, whether the prescribed and acceptable accounting frameworks and standards. So this person must be what? Honest and truthful to what? The duty that he is hired to perform under psycha. So I'm not going to go into depth. You can also pause and just read for yourself for some of this, or you could also wait for the individual chapters that we'll be covering. And then objectivity. Professional accountants should not allow bias. So when we talk about objectivity, we're saying that you should not be biased. You should state things the way they are. You should not have a conflict of interest. For when you are hired to produce a true and honest and a fair presentation of what's really happening where in the day-to-day business of the company, where the intended user is not active. Remember, link it to what? The split between ownership and management, where we said that the natural development of owner to manager, where the people who own the business are not involved in the day-to-day running of the business. So meaning that this person, when we're saying, come and evaluate and do an official inspection or an examination of the financial statements, and then provide an unbiased opinion, which might arise because of conflict of interest, bribery, and some of the inherent limitations that we are going to cover. So with objectivity and conflict of interest and undue influence of others to overrule, so we're going to override what the opinion to be provided. We are going to link it with the inherent limitation, the threats of audit. So we're going to come to that. So we're going to also talk about professional competency, meaning that the auditor must always be well-informed and knowledgeable and have recent understanding. So meaning that we're talking about, is this person qualified proper and up to date in terms of skill and knowledge, and up to date with the current standards that are being recommended by IFRIs to be used by this the client's company. So when we're also talking about the client, it is also important to say, when we're talking about the client, we're referring to the company. So it is also important that I also note that and communicate that. So now, so far, before I lose, or let me just complete this. So when we talk about competency and judicate, professional competency, we're talking about the requirements, attain and maintain professional knowledge and skill at a level which ensures that client or employers will receive the utmost quality or qualified service. So that's what professional competency and judicate is all about. And then we'll also speak to what? Confidentiality. Confidentiality is all about keeping the client's information safe and sound and not using it for any beneficial reason whatsoever, and should not be shared with any person. Professional behavior. Professional behavior, it's all about the conduct or how a professional auditor or accountant should carry himself and behave in a manner that will not put the professional body in any way possible in a situation which will compromise the integrity and the credibility of the professional body that they are registered under. So this is what you're going to be looking at. And when we're talking about professional behavior, you shouldn't be a racist and all of that. So you may dislike black people or you may dislike white people, but please make sure that you keep it to yourself. When it comes to this job, you don't do that. So these are what we're also going to be looking at: threats to compliance in alignment with what I was speaking about, objectivity. So due to objectivity and the conflict of interest that there might arise, this is some of the things that will happen. Self-interest. Sometimes when you happen, you find out that you're going to review and you get a statement. Now you have the directors, you're going to be looking at the financial statement of a company. Now the directors see that they have not been doing things in alignment with the prescribed financial frameworks. Then they recruit you on the side. They start saying, no, please turn a blind eye to certain things because we will do this to you. I'll send you this certain amount privately. Then that's called what? Self-interest threats. So now the body will regulate such things, the prescribed body that this person is enrolled under. Self-review threat. We will have a scenario when I'm going to cover some of the things. You cannot audit what was created by yourself. So we will have an instance where the professional accounting body was called to tabulate and create the financial statements of the client's company. And then later on at a stage, the company or the professional body must come back and audit. That will not become an audit because we cannot audit ourselves, because we were called as specialists, not internal what directors. So meaning the financial statements were prepared externally. So if ever they are calling the same company to do an audit, it will not be regarded as an audit, but well, it will be regarded as an overview. Or sorry, not an overview, a review. So if ever we are coming, there is also a threat to say, if ever we are auditing ourselves, when we have made errors of financial material misstatement, we will want to turn a blind eye to it. Because why? We don't want the body does not want to incur anything that will bring anything less than what they pride themselves on. So if ever they pride themselves on not making mistakes, and then they come across a point whereby they make mistakes, they will not want to admit that. So that will be a self-review thread. So these are some of the things that we are going to be speaking about. And then there's going to be familiarity, close relationship, intimidation, where some of the auditors, their lives are threatened by certain people, where the directors could hire people to come and threaten your life and say, no, 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 you are going to provide this opinion at the end of your official inspection or your audit. Because this, at the end, as I've already said, that the primary reason is that there is a split between ownership, where the owners want to know that can they have confidence, which is the second point. And if ever they don't have confidence, meaning they might fire them, which will then speak to accountability. Because if ever you are doing things that are wrong, the consequence could be you being demoted or fired from the job, and worst case scenario, you may get arrested depending on the magnitude of what you are doing. That could be what, immoral or unethical to the business conduct. So I will not be covering this proper. This will be covered at a later stage proper, but this is what I wanted to know. So now it is important. So I said because of the definition, remember, for now, let me just pause for a minute and come here to what we are talking about. I said that the first thing is that the need for audit, the split between ownership and management, where there is a gap, and this gap is arising from the natural development of owner to manager, where the people who are running the business, who own the business, are not running the business on a day-to-day basis. And this now has created a gap, and the solution to this gap was to us having an audit. And an audit is an official inspection of an organization's accounts, typically by an independent personnel who is under an independent body, which is an accounting body. And then that accounting body will be prescribing or giving a code of conduct on how this independent person should behave and carry himself for him to be credible, and also so that he may then do things that are what right, because he understands that also he is also accountable to a accounting body which is responsible for regulating him or her. So second to that, then we said the professional, which in our case we will be mainly focusing on psycha. Then psycha will then dish out what we call fundamental principles, which those principles are what it's what we have covered, which is what, when we're talking about your objectivity, your integrity, professional competency, and duty care, where we said integrity is about you being honest, truthful, and have fair dealings. And then when we talked about objectivity, it's all about providing an unbiased opinion and not having conflict of interest. And conflict of interest normally will happen because of what? The threats to compliance. Some of the reasons it's what? Self-interest threats, where we said because of that, the person might have what? Those might be having now beneficial motives, that he says, I must turn a blind eye to this because I stand to benefit this. Or it could be familiarity, that the company is auditing, the person responsible for tabulating financial statements and financial reports could be a sibling, a relative, or a brother-in-law or a sister-in-law, or a friend at secondary or tertiary. So now we are going to evaluate those threats. So the accounting body that will be dishing out these people, or this auditor, must then evaluate those threats before they distribute or allow this person to meddle with the financial statements of that particular client. So they will then take that person and put that professional auditor into a criteria, assess him and say, okay, no, it seems they will sit him and induct him again and say, no, remember, these are some of the threats that you might come across that will threaten your compliance to the professional body. This could be professional what self-review, as in I've already listed them. So now the professional body has to evaluate, or they must do an evaluation of what those threats and minimize them to an acceptable level, and say we must reduce this to this, so that this person will not will not come with what results that could subsequently affect or have a negative impact to the accounting body. So this is some of the things that they're going to do. So if ever, for example, I'll use the one of self-review. We will not take, if ever Anta was hired under our body, let's say the body is called a affluent commercial firm. Now, this person, the company came and said that they wanted their financial statements to be audited. And then they hired me, Anta Malabani, to do or table those financial statements. So since I'm an expert and they come back and they say, no, to the same firm, affluent commercial firm, they want me to what? To do an audit. The firm will have to allocate someone different to come and do what? The review over my work, not me to redo again a review on what was done by me. I already know if ever I did wrong the first time. It's like doing math. You cannot study math on your own, because if ever you are wrong, you will continuously use the same formula. But if ever it is quite a number of students, or one or two, no, two or more people in the same room, someone would be able to correct the other and say, but didn't ma'am say this, or didn't the tutor from what the YouTube channel say this now? So when we have two people or more having to look at the same thing, we are able to see the faults or the errors that are made by the previous person or the initial person. So this is what they are speaking to, or when they're saying the evaluation of those threats that threaten compliance, and then we then mitigate them to what? An acceptable level. Why are we saying acceptable level? Is that the person who's also coming to do the review, for example, over the self-review threat, it may be a different person, but as long as, because they are still under the same company or the same firm, they will also say, no, let me just turn a blind eye because I know this person, he's a colleague, so I don't want anything that could also jeopardize his professional or her professional career. So then we will mitigate or reduce this enormous risk or threat that threatens the compliance. So then we address those threats by saying, okay, if ever Anta was the person who did this, who tabulated the financial statements, we will appoint someone different, meaning that we are addressing the threats that could be found. So luckily we are done with it, that was chapter 2, but it will be now dissected at a more detailed layout, proper, as with the episodes that are going to be coming, where we will be going chapter by chapter, becoming more detailed. So now this is more of a summary. So now, as I was saying, meaning that we were here saying that the evaluation of those financial reports is called audit. For audit is defined as an official inspection of an organization's accounts, typically by an independent person under an independent body, which I've went to chapter 2 to try and link this, because this person does not just want to hire the intended user when he's coming, because remember there's a gap. He's appointing someone who must be who must have what? Professional competency and duty care. So this person must be under a professional body to regulate him or her. So this person, as I've already said, I will read this. The solution to the gap was to appoint an independent person to evaluate the reports made by the managers and provide an opinion. The opinion provided by the auditor will enhance the degree of confidence of the intended user or of the users. So now this person, when he provides an opinion, that opinion will be based on the review or the inspection and the examination of what the financial statements, to want to come to a point and give an opinion. And this will then become what we call an assurance engagement. When the auditor provides an opinion, that is regarded in auditing as assurance engagement. So now this then takes us to here. What is assurance engagement? So when we're talking about assurance engagement, there are things that I've already highlighted. In auditing, it's not about having to cram things word for word, but it's about knowing key concepts that you are going to be focusing on. So assurance engagement is defined as what? The professional accountant expresses a conclusion or expresses an opinion designed or intended to enhance the degree of confidence of the intended user. So when we're talking about assurance engagement, the most important thing about assurance engagement to note is that the auditor, not the auditor, who is the professional accountant, has to express an opinion which is intended or designed with the intentions of enhancing the degree of confidence. So when you hear assurance, anything that has to do with assurance engagement will be in relation with what? The providing of an opinion that will do with the enhancing of the client's what? Confidence, which is what? The second reason on why we need a bargaining audit, why we need auditors or audit. So that gap, now he's coming as the solution to provide a gap, to say be confident or do not be confident in the person you have appointed. Subsequent to the lack or gain of confidence, that person will remain in occupation of whatever position they are occupying. But by default, if ever the opinion is also coming and saying that no, this person, there is no compliance with the acceptable and prescribed financial standards. Subsequent to that, we can all say that the person might lose out, get demoted, worst case scenario, imprisoned, or face criminal charges. So now when we talk about assurance, the most important thing to take into account is that when we talk about assurance engagement, it is about the express of an opinion. But remember, audit will not take place if ever we don't have financial statements to base our opinion on. For when that person comes, he does not come and look at the directors or the managers and say they are corrupt. He must have a solid ground to then bring about where this opinion expatiates from, where it comes from. So then now due to me highlighting the subject, sorry, I forgot to continue read this out. Other than the responsible party, the responsible party I'm referring to the directors or what? The managers, about the outcome of the evaluation or measurement of a subject matter against the criteria. What am I saying here? The subject matter and the criteria. Because of that, I'll have to read this so that I will recall what I was actually getting at. Now, due to me highlighting the subject matter versus the criteria under the assurance engagement, this means we have elements of assurance. So this now, to explain it proper, we have what we call a subject matter and a criteria. of which those things will form because of what? Assurance engagement. Assurance engagement, we want to produce an opinion that is intended to enhance. But where is the opinion coming from? Remember, an opinion will always be formed based on something. Even on social media, we all know that when you form an opinion, it's because there's something to comment on. An opinion, it's a comment, and a comment, it's arising from a review of a particular thing. It could be a post, it could be a video, it could be an audio. But in our case, in auditing, it is always going to be based on financial statements. That's what you must know. So when we once say assurance engagement, then there must be an opinion that is what? Enhanced, that is intended to enhance the degree of confidence. The degree of confidence, where is this opinion coming from? An opinion will be coming on the financial statements. And those financial statements, meaning that we will have what we call what? A element of assurance. So the elements of assurance, here's the table here. We will have what we call a third-party relationship, which I will then unpack it according to the split again, the need. That third party, it includes professional accountant, responsible party, as I've already I've highlighted there in the note, I've highlighted there in red, and the intended user. But I'm going to structure this for you so that you can contain this and you don't lose out. One, this third party, it's coming back to the split between ownership and management. So now we're going to readjust or prepare it in the sense. We are going to have the gap, which is the owner, the ownership part, which those are the intended users, the owner, you, the person who's currently looking at this audit overview. The intended person, the owner, and what? The responsible party, which are the managers, the people who are involved into the day-to-day business. Between these two individuals, there is what we call a gap that lies. And the solution to this gap, it was what? The professional accountant. Who's going to what? Who's going to do what? An evaluation, which is what is the subject matter. The subject matter is that we want an official inspection of the financial position or the financial report resulting of what? As a result of operations of what? The company. So the subject matter is that there is a gap, and in that gap there are day-to-day bargaining activities that are happening. So now we have the intended user, which is what? The ownership part, as in linking it back to what? The split, and what? The responsible party. And there is a gap between these two, and the solution to the gap was the professional accountant, who's there to what? To do an evaluation of the financial reports. And those financial reports arise from what? The day-to-day businesses of the client's company. So those day-to-day activities, which will come in the form of what you call your which will come as a result of what? Your expenses, your incomes, your assets, your liabilities, your owner's contribution, and all of those things. We will have what? International financial recording standards on how to consolidate and cover that. So that's why we'll have what we call the subject matter versus the suitable criteria. So all of those things have a class or a prescribed method on how to record them, and the person that the owners have appointed to run their businesses must record all of those things and classify them and tabulate them in alignment with the suitable criteria, which is what? IFRS, as the prescribed or acceptable recording framework or standard. Financial recording standard. So when these people are failing to do that, or when this person is complying, this will form as what? So we're going to be assessing and inspecting those classes of transactions or those subject matters under the financial statements arising from those operations. So when those people do not do in compliance with what? With the suitable criteria. This is what audit is all about. Trying to say what the standard is prescribing and what the appointed or the responsible party are doing. Is it agreeing now or is it contradicting each other? Once they cohere or they agree or they go hand in hand, this is going to be sufficient appropriate evidence for the auditor to say all financial statements are fairly present in our opinion. So this then forms an opinion. But once they say the opposite is done, it means that becomes sufficient appropriate evidence for the auditor to say no, things are bad, where we will have what? A modified opinion, an adverse opinion, or a disclaimer opinion, which is the worst case scenario. And then all of this will all be summed up in what? A written response. So why in writing? This in a written response. So the auditor at the end, he's going to provide what? A written assurance report to provide what? Which is what? The opinion. To say what? Audit a report on fair presentation. To say the statements are fairly presented or do not fairly present, which is arising from what? The subject versus what? The suitable criteria. I will not go into depth with this. I will come back to it again when we are doing what? This chapter, which is chapter 1. Remember, right now it is about the integration. If ever I'm also moving quick, please don't be discouraged to go back. There are also videos that are going to come back. But now I want to give you more of an overview and interlink, and to say that what you have been thinking that is that module or that chapter, it's standing independently. There is no such. All this subject or this chapters are interlinked. So all of these chapters, since they're interlinked, it's very important that you understand them. So now I'm trying to pave them or explain them in a way or tutor them in a way that once you start saying this must give you this. So so far, let us do a recap. One, the need for auditors. The need for auditors, we said the primary reason is the split. And the split, what is the split? The split, we're talking about the natural development of ownership to management, where the people that own the business are not involved into the day-to-day running of the business, which has then led to a gap. And the solution to this gap was to do what we call an audit. And what is an audit? It is an official inspection, meaning that already by having this sequence, you already have the definition, the reason why we have auditors, and as I've already said, the solution to this gap was to do what? An audit. An audit is an official inspection or examination of an organization's financial statement or accounts by which is performed by an auditor who is an independent person who is going to be performing this official inspection, who is registered with a professional body, which is an accounting body. Normally they are regarded as the CAs, our CAs and so on, under institution bodies like SAICA and a number of others that we will cover at a later stage when we're going to be doing the chapters unilaterally. So with that being said, now we said because of now that we then have that scenario, and then we said due to that the mentioning of an accounting body and this person being registered under a certain thing, that then led to us having to understand, okay, since this person is registered under a certain body, what is the body doing? That body, obviously, every body or every organization will have a code of conduct and it will have its own principles. So now once you mention bargaining accounting body, you'll be like, oh, principles, okay, and code of conduct. What are the principles? Those principles, we outline them to say it's integrity, objectivity, professional judicare, and professional competency and judicare. It is also confidentiality and professional behavior. And once we said, oh, when you say objectivity, you know that, oh, integrity is about honesty and fair dealings. Or when we talk about your objectivity, we are referring to providing an unbiased opinion and not having conflict of interest. Why are we speaking about conflict of interest? Because the bodies have realized there are threats to compliance. Some threats are volunteer and some are not volunteer. How? We're saying that sometimes this auditors sometimes become threatened, intimidated. They face familiarity where they have respectable friends or family members working in those companies or the client's company. So we covered some of those things. So we then said, okay, so this person, then he becomes qualified to provide an opinion. And we said that that opinion, which is to assure or mitigate the gap that is found between the owner and manager, we said he's providing an opinion to enhance an opinion. And that opinion will be regarded as assurance engagement. And what is assurance engagement? And we said assurance engagement, once you hear the word assurance engagement, what must come to your mind is that the professional accountant or the professional accountant expresses an opinion which is intended or designed to which is intended to enhance the degree of confidence of the intended user from what there is the intended user, coming from what the things that are performed by the the responsible party versus what the subject matter. And we said once you say assurance engagement, you must speak about the express of an opinion designed to enhance, looking at what the subject matter versus the suitable criteria, which then has led us to speaking about what the elements of assurance. And then we then spoke about the table and I explained, and those examples will come in audit application and a review application. I hope we'll cover that at a later stage, but this is what's most important at the moment, because I want it to be like economics, to say when there's heavy rain, eventually there'll be flooding. When there's flooding, this is what we will actually incur. So now remember that because of the elements of assurance, which is the suitable criteria versus the subject matter, means right now, when we are going to provide that opinion, remember I said the process of comparing the subject matter, which is the company's financial accounts resulting, financial position resulting from its operation versus the suitable criteria, it becomes sufficient appropriate evidence. So because of that, an opinion in auditing, there is no auditing if ever we don't have financial statements. So it means we need financial statements for us to form a basis. Then when the assurance engagement is about providing an opinion, the auditor will need to gather sufficient will need to gather what audit evidence. This audit evidence will be coming from here, where we are going to require this. Then when we talk about audit engagement, what is audit engagement? Audit engagement or audit evidence will be what? Audit engagement. When we speak about audit engagement, we are talking about the gathering of sufficient appropriate evidence to form an opinion or to form a basis for our opinion. So when you hear audit engagement, what must come is that we are going to be gathering sufficient appropriate information. So when you think audit evidence, you are thinking audit engagement. When you think audit engagement, you are thinking audit evidence. But audit engagement, it is the process of gathering that information. So now to form what? A basis for our opinion. So now this is what we are going to be having. So when we are going to be gathering, remember, Assurance is about providing an opinion. So before providing that opinion, it means the audit engagement must have been performed pre or prior what us getting to what the expressing of an opinion or the providing of the opinion, which is the assurance engagement. Now we must have what the audit engagement before, which is about audit evidence or the gathering of sufficient appropriate evidence to form a basis or to form an opinion on whether the directors who are responsible for financial statements have applied IFRS appropriately in presenting the financial position, financial performance, change in equity, cash flow, and disclosure notes. So we're going to be looking and gathering this information. And then when we're going to be gathering this information, looking at the statement of possession and all information, financial information related, not only financial statements, but all information that led to the development of financial statements and anything that falls within the scope of what the auditor will want to gather to get to a point whereby he says this is appropriate or sufficient appropriate evidence. Anything, the financial statement, we will also be collecting that information using what we call assertions. Assertions is a class of transactions. When we speak assertions, we're speaking about a class of transactions. So it means financial statements, the financial statements will have its own class of transaction. So when you speak about assertions, so since you are going to be gathering sufficient appropriate evidence, where from financial statements, how, using assertions. What are assertions? Assertions are a class of transactions. Class of transactions, why are you referring? I'm saying that the balance sheet, there are classes of transactions or transactions that will be recorded in the statement of positions that do not fall in the statement of profit or the statement of performance, which is the profit or loss and other comprehensive income. So the class bargaining, those assertions are the following: the assertions of existence, anything that is under the statement of profit, the statement of possession, the balance sheet, must be in the hands of the company or the client's company. What am I saying? I'm saying that if ever we have our fixed assets, saying that we have 5 cars, we must have cars that are 5 in the company. Or what am I saying? Let me say it in monetary sense. If ever we have cars on the line item, yeah, the non-current assets, PPE, that value, if ever it's the value for 5 cars, it means the auditor, when he goes to do an inspection, he must find 4 values. If ever that's the value of 5 cars on the balance sheet as an existing value, it means we must have cars so they are worth that value. If ever every car is worth 100,000 and we have 400,000, it means we must have 4 vehicles in the clients. So then this is what, because this is the statement of possession, and the statement of possession is what we have on hand, the balances on hand, which the balance could be cars, could be assets, could be owner's contribution or liabilities. So through what? Assertions. So assertions are a class of transactions. So we are going to be looking at what? The existence of things on that statement. So when he approaches anything, looking at the statement of possession, he must know that these things must be in existence. There must be existence. If ever we owe 10,000, we must have, if ever the statement is reflecting 10,000, it means we owe 10,000. And then we have a class of transactions, and I've already said the rights and obligations. These rights and obligations, I'm not going to explain everything proper now, but let me just cover this. Rights and obligations, we will have things like what? Your trade and other receivables. Trade and other receivables, when we do things like what you call your accrued income, which it means we have settled those rights. So we have the right to receive the money because we have already provided the service. So we are still yet, or we have already transferred ownership of what the goods and services under IS 10, no, IS 15, but let me not mix accounting with auditing. But those rights, we have already settled those obligations, the obligations for the owner. We have transferred, if ever it's an asset, we have already transferred the goods, or the goods, if ever it's a good, we have already transferred ownership, or if ever it's a service, we have already performed. The only thing that we're waiting for is what? Money. That the thing, accrued income does not go into what? It does not go into the statement of performance. It goes into the statement of possession because that will be regarded as an asset under the classification. Remember, all of those day-to-day activities fall under the elements of accounting. Remember, and those elements of accounting are the ones that are used on the statement. So I'm not going to go into depth. We're also going to be looking at the assertions for the statement of performance using assertions again. So assertions will always be about a class of transactions that fall into a certain internal control or a statement, but in financial reporting. The assertions, bargain financial performance using assertions, we will look at bargain occurrence. When we're saying occurrence, we're saying, have we benefited now? Let's say, for example, we will have expenses. If ever we have already benefited from electricity, we say already we have used electricity, but we have not paid. That has already occurred. So because of the occurrence, or that already have taken place, it means we must record that, for it will be classified as an expense because already we have derived the benefit from that particular good or the service. So now this will fall under what? The expense of what? The statement of profit or loss and other comprehensive income, which is the statement, the financial performance, using what? This class of what or cut off, where we're saying the expenses of this year must fall under this year. They must not overlap to the other side. We know all of these things, but I will not cover all of these things. I just had to cover two so that we pass for the sake of time. So now this implies that anything which we will read about, which in the slides, which has to do with bargaining, speaking about the gathering of evidence, so on, and also gathering of sufficient appropriate evidence or audit evidence, will be what? Regarded as what? As audit engagement, because audit engagement is about gathering sufficient evidence to form an opinion or a basis for our opinion. So we're going to be looking at what? Financial statements. Those financial statements, when you think of financial statements, you must think assertions, because assertions is what? It's how transactions are classified. So when you look at the statement of possession, you must approach it differently from how you would approach the statement of other comprehensive income. Because why? It has its own ways of classifying. So you cannot look at existence while you are on the statement of change, bargaining, the statement of performance, and also the change in equity, cash flow, and also they also have their own ways. So I'm not going to cover that as of now, but this is what we're looking at. Audit evidence, as I've said, audit has the responsibility to gather audit evidence to support. We are not going to, you don't just provide an opinion. That opinion must have something reinforcing it at the back, which is what? Audit evidence. Auditor has the responsibility to gather audit evidence to support his or her opinion on whether the assertions of the directors, how the directors have classified and recorded everything under the prescribed financial frameworks embodied in the annual statements are fairly presented. Because once you classify according to the prescribed, it means all transactions will be classified accordingly proper. Note, auditors do not make conclusions based on assumptions. You don't come here and come with biased opinions, or you look at someone or you have beef with someone. If ever you have beef with someone in the company you're auditing, you must uphold professional behavior, and understand that the business, your personal affairs and your duties as an auditor are not symbiotic. They are apart, and you must draw a thin line. So you see, now we are explaining this thing as if it's just a day-to-day activity. So now this means we have to define what is sufficient audit evidence. You will then, Corinne, you have to say, okay, quantity, e.g., evidence must be enough to support. So you're not going to look at one transaction and say, oh, there's material misstatement on this particular transaction, so everything is wrong. No. For you must also take into account, because we are also going to have what we call professional judgment and professional skepticism. So you must approach everything with a questioning mind, and you must also have an understanding based of experience accumulated, a judgment. So you will accumulate judgment due to also experience and knowing of the profession, and say, oh, this is a minor mistake that might have happened because of this. No, they said they will receive 5,000 because they had they had debtors, but not all of the debtors paid. So that's why there will be a difference. You must know all of those things. So we move to what is appropriate audit evidence. Quality of audit evidence can be broken down into reliability and relevance of that information. So I'm not going to be looking at the financial year 2026, looking at the revenue line item, and then I want to allow the directors to bring a receipt 2010 World Cup. No, we don't do that. Here we want things that are reliable, that are relevant. So we need relevance. So if ever we're looking at the financial year this year, we need classes of transactions that are in alignment with this financial period. So also reliability. When we approach this appropriate evidence, we have what we call a hierarchy of audit evidence, which we're talking about the reliability. How reliable is the audit evidence? Reliability of audit. Some evidence is more reliable than other evidence. Why? Remember, you're auditing a company which we are having an issue of a gap where the intended user is already questioning what the responsible party, and they are of the impression of which there could be fraud, even if we're not here for fraud, but we're just taking everything from a holistical perspective. So such things. So when this person, we are saying the hierarchy, when we're speaking about how some information will be more, or some evidence will be more reliable, we will be looking at the chain of command or the chain of access of that information. The longer the chain, the more it becomes more probable and possible that information may be altered or tampered with, or there might be configuration of information or evidence which may be falsified. That's why we talk about professional skepticism. Have a questioning mind. Do not accept the things from face value. You see, so we're going to be looking at some of those things, looking at that. So to simplify, evidence developed by the auditor is the most reliable. So if ever the auditor goes straight and does a physical stock count, that information is reliable and it will be the most reliable. Any information that is conducted or it's obtained, or all evidence that is obtained by the auditor himself or herself, will be the most reliable information on the hierarchy. And all other information that is to be obtained using other channels, for example, let me read another one. Evidence provided by the third party through the client is less reliable. So we're saying that if ever right now, for example, the directors, let me give an example. I don't know. Let me just give you this example. Let's say we have a scenario where the directors say we have we have 50 million in the bank account, and then the auditor requests the bank statement, and that bank statement has to come through the same directors. Those directors can tamper with that statement. If ever the information is presented before the requirement of the statement will then be adjusted. When it comes, they must tamper with it. But temporarily on. And then if ever the statement was acquired before, and then they have to provide statements and they already know the amount, they can just change the amount, so that when the statement, the auditor, when he looks at what the statement is saying and what's written on the statement, he'll say, oh yeah, things are making sense, and while they are not in reality. Because why? The information is coming from a third party but passing through the same person is actually being reviewed or being what? Assessed. So I've already explained relevance of evidence. Factors that determine. So now we have already gathered. So meaning that since we are already speaking about, we said that we must have what? Sufficient evidence, and we defined it. And then we spoke about what is appropriate. And then what is appropriate will be broken into two segments, which is what? How reliable is the information? The reliability of the information and the relevance of the information. We have explained what the relevance. Remember, all of this thing, it's all about gathering information. So we want things that are going to be relevant and reliable at a given point in time. So it means that there are factors that determine whether sufficient, appropriate evidence has been obtained. So we're going to be looking at the significance of the potential misstatement in the assertions. So sorry for that, excuse me. Okay, sorry for that. So we're going to be looking at that, the materiality of account. We're going to be looking at that, the significance of potential misstatement of what? Those assertions. Remember, we're not talking about misstatement in the assertions. They're referring to how things are not documented proper, or how transactions are not classified proper in their respective statements, where things might not be actually reflecting the actual reality or state of the company, also in alignment with the prescribed policies or standards. And then we're also looking at experience gained during previous audit. So source and reliability of information available. So these are the factors that are going to, because sometimes we will perform this audit, we will want evidence, but we will not access all information, because some of the directors will not want to be cooperative. That's why we have things like disclaimer opinions. So already these are some of the factors. So once we have a disclaimer opinion, it's one of the factors which comes from here. What source and reliability of information available, which is what the factor that has led to what the obtaining of the lack of us obtaining what sufficient appropriate evidence. So then has led to us having to provide what we call a opinion, which is regarded as a disclaimer opinion. Because of that, this is arising from what some of the factors that determine that we managed to gain. So since we didn't gain sufficient appropriate evidence, a lot of it, so we are going to provide an opinion that is what uh, that is a disclaimer. So now, since we are saying those are the factors, and we will firstly had to define, explain, understand what is sufficient, what is appropriate. So there is a difference. That's why we don't just say sufficient. We can have sufficient information or get 19 something or get 2010 World Cup, that's South Africa, which we don't know. When are we also going to experience that again? But it's fine. We're not there. We're here. Let's remain professionalism. Let's remain professional. So sufficient speaks to enough information. Appropriate speaks to reliability and what reliability and relevance. And then when we speak about reliability, you must think about the hierarchy, where what's more reliable, what's less reliable, what's most reliable. So once you are going to be looking at it from that, then one thing gives you another. So once I start thinking, oh, appropriate, oh, I'm thinking reliability and what? Uh, Relevance. What is relevance? Or relevance is that the information must be relevant to the class of transactions or to the assertions that fall into a particular period in time, which is the current one that we are auditing. And then what is reliability? Reliability is we're speaking about the chain, yeah, how the information is flowing. That's what we are speaking about. Where we want to know what's really reliable and what's not reliable. So there will be types of audit procedures that will be done to obtain that audit evidence. You know what? So we will have what we call inherent limitations of an internal control system. So we will firstly have to do what a risk assessment procedure, understanding. For us to obtain audit evidence, we firstly have to understand the client's process to identifying potential risk. So if ever we are going to want to audit a certain company, we will first have to look at the nature of the company and to say, oh, this is a company that deals with this. Where could fraud most be found? Can we find fraud in inventory? Let's say we're talking about a company that is a dealership. A dealership, you cannot steal a car, man. But if ever you're working at a certain company where they sell minor products, carryable bargain products that are minor, man, that are not huge, enormous in size, there is potential of things like inventory being what the inventory misstatements, because there might be stolen items that we don't know about. That's why when you were doing activities, you would say they are missing bags, there is missing this and that, but we cannot have a missing car. How did they steal a car like as from our inventory? So we have to also look at the nature, and so that we can identify areas with high potential of risk. So because where those risks are, those are where material misstatements normally occur, because we also have to take into account not all material misstatements happen because of what deliberate intentions. So due to experience, we also know, and due to professional judgment, we know it's very unlikely, man, for a car to fully disappear. How do they drive the car and whatnot? But unlike a watch, a wristwatch can be stolen and someone put in their pocket, and then we are of the impression that we have 5 units while we have 4 units in reality. So we have to look at the nature. So because in each and every company, and depending on the nature of the company, there are internal controls that are put in place to try and minimize the probability of risk happening. And those risks sometimes they happen unnoticed, which cause material misstatement, of which, or we also are going to look at, yeah, let me just maintain it at that, because right now I'm not going into depth. So we're going to be looking at what judgment errors on the nature and extent of controls implemented and risk assessed. So with these inherent limitations of internal control systems, we're just saying that normally, when we are going to be gathering information, we also have to look at the weakness of the systems that have been implemented, because all systems normally have weaknesses. For example, management usually usual requirements that requires more. Why is this thing of typing only one? It's a problem. That the cost of internal controls do not exceed the expected benefit. So sometimes one of the problems that we face is that when we talk about control systems, let me also define that what they are saying in this point, or what I'm explaining in this point, is that management normally will not there are very few companies that have up-to-date and expensive up-to-date internal control systems. Internal control systems are those procedures that are put in place to minimize the possibility and occurrence of a risk in a company. So that's the definition of what an internal control is. So let's say now we're talking about a company that deals with watches, for example, or guns. The company normally will not go to an will not go out and want to have what you call, let's say, scanners. They will not want to install, because those scanners at airports, they are very expensive. So what they're saying is that the cost of internal controls does not exceed the expected benefit to be derived. So they're saying we can buy that machine, but what are we standing to benefit from that normally? So they will want to weigh that. So that causes normally an issue, because why? They will not want to implement the most up to date and most solid internal control measure if ever it is exceeding the expected benefit, which then allows for what, for risk to happen. Because the more expensive of the more strong the internal control, it means the less at risk the company will have in terms of what, having what, information that is not really reflecting reality, which is what when we're going to be gathering information, we have to understand, that's the first thing, understanding the processes and identifying potential risk as what arising from the inherent limitations. So you will read some of those things. Let me just peruse a bit, so that you can then pause the video if ever you feel so, and just also look at them. But worry less, they will also be explained at a later stage, as I've already communicated that quite a number of times. But even now, I am still trying to accentuate that or emphasize that. Second to that, remember the first thing was to what? It was understanding or assessment of risk. And to to do risk assessment procedure, it is coming from understanding the client's company. From there, further audit procedure, which is what? Audit procedure is that we must do test of controls. So we're going to have components of an internal control system. So when we're going to be testing, we're going to be looking at the environment, but in control environment, and what risk assessment procedure, and what information system, and bargaining what you call control activities, and monitoring of those controls. So basically here it's all about just saying, okay, since we're going to be gathering, we also want to look at how does information travel in this company or in the client. So one of the ways of also further audit procedures that we're going to go a step further, because the first one was about understanding the nature and extent of the company, or saying, oh, given the nature, this is what we would, these are the most possible areas, whether it could be in the expense, where we are going to be focusing. And then we enter now and we say we want to go further by understanding the environment. We want to look at the control now, while within the organization, not looking at the nature, but looking at within the control environment, the risk as we are going to, that will come from that environment. Oh, okay, they don't have or tight security or updated systems. We're looking at the control environment. Then we're going to say, okay, there is possible that some of the products have been stolen here. So okay, now, okay, this is alarming. Then okay, fine. Then me as an auditor, I then look at where should I start looking. So as now as I said, think about this as your company. It means me as your auditor, or you as the auditor, will then have to look at an area that will have to do with anything that would come or arise as a risk of that lack of uh, safeguard in that particular environment. And then we're going to look at information. How does information travel? Is in this company, do we have what we call division of duties? Is one person able to do the recording, receiving of goods and services, and also do what we call the recording and receival of those particular things, as I've outlined? So is one person responsible for what or a plethora of information achieved, receiving, and all of that? So the risk, and also how does information go? How do who is responsible for recording? Who is responsible for receiving orders? How does he write it? Who does it then transfer to? So we look at the nature of how information system, or how information travels, because the more information is captured by a single person, the higher probability of, you know. So we're going to look at that, and then the control activities. So how do they mitigate those problems? Remember, you are not coming as an internal auditor. You are coming as a registered auditor. So I forgot to explain that, but I will explain it now. Remember, when you are coming as a registered auditor or an external auditor, their responsibility is to express an opinion, and they must be independent, and they are not the employee of the company. So all of these things here, they are coming doing an evaluation, not making an implementation. You are coming as an assessor, as someone who's doing an inspection and examination. For you to gather information, you are not here to prevent material misstatements. You are here to check, if ever, did the company itself take proper steps to prevent that, by understanding its nature, and then after its nature, understanding what its environment, risk, and its information control, and monitor, how they monitor those internal, those controls they've put in place. Normally, then that's where the importance of what we call bargaining, an internal auditor, who then who's an employee of the company, who's independent, but who does independent assessment on behalf of the board of directors. So the external auditor, remember, when you look at this now, remember, am I looking at this? So don't be confused. But when you get here, when you look at the components of an internal control, look at it through the lens of an internal auditor and an external auditor. And now I'm defining what an internal auditor is. An internal auditor, the characteristics or an internal auditor is what? Is someone who's employed within a company, but is an employee of a company, but is independent of what? The department that they are in, and they also do independent assessment on behalf of what? The board of directors. And the internal auditor will provide an opinion to enhance the degree of confidence of the board of directors, to inform them that the internal controls you have implemented are working fine. So you don't come in as an external auditor or a registered auditor. When you provide an opinion, it is to enhance the degree of confidence of the intended users, not the board of directors. You are not here to want to enhance their confidence. You are not for their confidence. For their confidence, is looked after by the internal auditor. But we'll not waste more time on that or dive deeper into that. So now, with that being said, as we are talking about the understanding of this in working this system, the control, the environment. Now, when you thought of this components of the internal control, so it means now we are linking with chapter 10, which has to do with what? Revenue, which has to do with what? Revenue cycles and what? The acquisition and payment. And also chapter 16? Sorry, I'll check my material proper. I couldn't also write or do notes for these chapters, but I will cover them proper. But right now, remember, it's about an overview. Don't be discouraged. So now, since we are saying we're looking at what? Information, control systems, monitoring, risk. So we have to look at what we call acquisitions and payment cycles. How do we acquire information? Let's start with reading the acquisition phase. Ensure only goods which are acquired that are required are ordered. Ensure only goods which are required are ordered. Let's not order anything that is not aligning with the operations of the company to be bought or to be ordered. So what I'm saying is that the board of directors or a director should not order a car or do a business trip for their own personal reasons using the company. So ensure only goods which are required are ordered and are received by the company. Goods are for suitable quality and price. Goods that are for a suitable quality and price. You'll excuse my typing there, sorry for that inconvenience. So that's what acquisition is all about. Acquisition is all about ordering what the company needs and receiving it. So we also talk about the payment. Ensure that only goods that have been validly ordered and received are paid for. We are not going to do in reference, for example, what was happening at the Mahlanga Commission, where they paid for things that they have not received, the implementation of the cameras, meaning that they did not do this acquisition, chapter 11, the acquisition and payment cycle, because they ordered, yes, it may be relevant, they ordered the right thing, but they did not receive it, meaning that they should have not paid for it, because we must pay for what we have received. So we receive and then we pay as a company. Other than what, even you yourself as a customer, you get to your store, you say, give me the t-shirt, and then you pay. You don't pay upfront and then receive the t-shirt after. You receive first the t-shirt, you look at the t-shirt, you're like, okay, I like this, and then you have, why do you have the account, the asset or the good in your possession, then you pay. So that's the same thing that we're saying. But what was happening at Mahlanga Commission is a different matter entirely. So linked to this, to the control systems, we are going to be looking at how did things go about? Were things acquired? Did they pay? We're going to be looking at their orders. Okay, fine. Their orders, what is per unit? How much is per unit? Okay, we look at the payment side. Is everything, are they paying for what they've received? Or are they paying for what they have not received? Which then it's alarming, because someone can pay and then tomorrow and want to pay again using the business account, meaning that a portion of those things might have went somewhere, or also it might happen that they have paid for themselves but claiming that they are paying for the goods, and then tomorrow they'll come back and give us different stories. So we're going to be looking at that as auditors. So these are some of the things that they are going to be looking at. So ensure that payment is authorized. So we're going to be looking at the chain, bargaining, the controls that are in place, control activity, where we're going to be looking at what? Authorization of transactions. So we're going to be looking at authorization of the payments. So no person should just now order and next thing they're already doing payments. We must order and then we must have a senior who's responsible for what? The approval of transaction, the authorizations of those transactions. So this is what we're going to be looking at. You see, because what we want to cater, characteristics of what this cycle is, what the importance of this cycle is to what is to reduce loss of sales if products are not available for customers, bad reputation. So those are the intentions of this, what, the acquisition. So we must, the company want to also look at what are they always doing pre-orders to make sure that there's always stock, and all of that. You see, corruption, so and the auditor must have an understanding of what the document used in those cycles, in the cycle. So these are the documents that are going to be used. Goods received note, purchase invoice, credit note from what our supplier documents to give credit for returns. So this is what we're going to be looking at when we're thinking. This is what we're going to be looking at. So we are going to be requiring these informations. Remember, you are not running as an internal person, you are running as an external person, as a registered or a external auditor. So you are going to be requiring this. So depending on what you're looking at, so when you're looking at the expense side of things, or the class or the assertions of let's say liabilities, because creditors fall under what? Liabilities. Or if ever you're looking at it from the expense side, so when you're looking at these assertions, those assertions, or looking at this cycle of what acquiring or placing of what orders, you will then look at it through its assertions, and those assertions based off the environment. You will also look at what the info bargaining. You will also look at what the documents required. You're going to be looking at those documents, so you have to be knowledgeable of those requirements. So you must be able to request this information to act as a supporting, because remember, the auditor, when we're going to be discussing at chapter 11, when we're going to be looking at everything, the auditor will not cover each and every single thing every single time. Sometimes the auditor will choose to say, I'm going to be looking at the revenue. So when he's looking at the revenue, he's going to look at revenue, looking at its class of transactions and the documents that contribute to revenue. And if ever we're looking at payments, we will look at the documents that are paying. So if ever we're seeing the payment, we'll say, what is this payment coming from? No, we ordered this from where? We say, okay, then I want the documents that come from what? The document for what? The goods received note. Let me see that. Did you receive this thing? Who signed it off? So you're going to be looking. So once you are thinking about once you think about the components, you must also start thinking about this, linking it with the assertions to say this is what we want. Bargaining, ordering of goods, the documents used, requisition, purchase order form. So re tlo nyaka that order form to say, okay, we see that you are saying this is what you paid for. We wanted the document for it, the order. Where did you make this order? Did you place? So that if ever the auditor wants to obtain information to verify that the prices that are reflected there, they are not falsified, he can have that hierarchy of information and call the supplier and say, at this particular time, how much were you selling this per unit? Then he says this. And then if ever, right now I'm speaking to you as an auditor, I'm auditing the company of da 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 da. How much was the discount? Did you give them a discount or yes or no? Then he confirms. That's the hierarchy, which will make that information most reliable. But if ever he then chooses to say, directors, contact the supplier and tell him that I want his catalog at that given time, then that information will become less reliable because it will pass through the directors again. So that's what we're speaking about. So that's why we're saying auditing is actually interlinked, not as this difficulty that they are making it to make it come out as. So the receiving of goods, supplier, delivery note. So what was the delivery note? So I'm going to not cover this. So there's going to be the receiving of goods and the recording of goods after they've been delivered. Actual payments, bank statements. We are going to look at, okay, this is what you have paid for, because the bank statement is the amount that we have paid. So these are what the assertions in this session, or one assertions in this cycle. When we are purchasing occurrence, we must place an order. Purchases that have been recorded have occurred, meaning that we have placed the order. Accuracy, that the amount of purchases and other data. So we want things that are accurate. Payments, Leon NLA, its own assertions. The assertions of what? Completeness. All payments that should be recorded have been recorded. Once we pay, it means we're actually saying what? We must record this immediately, fully. Whatever the amount that we paid, if ever we paid 10,000, we must record 10,000 in our statement of performance. And then we also have bargaining acquisitions. All of these things that I'm highlighting, they have their even trade payables has its own what assertions, like the assertions of what existence. Remember, trade and payables will be falling under the statement of possession. So when we're saying about trade and payments, that's where we're going to find our bargain, our trade bargain. Our creditors control account, sorry for that pause, where we're going to have our creditors control account, which our creditors control account will be falling under our trade and other payables, meaning that it's our suppliers there. So there must be existence, so it will be falling under what? And then obligations, da, 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 da. So all of these things make sense when you know the balance sheet and how it goes about, plus linked with the assertions that we have already covered. So same applies with revenue and receipts. So this is what we are going to be having. So the director must study. The auditor must look at this thing from what? This thing. So he must study the functions of revenue, how revenue is made about. How do we as a company get our revenue? Where does it stem from? It stems from the order department. We receive orders from customers, and then we do invoicing, saying to the customer that we have received da 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 da, so and so and so. No, this is what the amount for the orders, that the amount in total is this. You have ordered this much, da 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 da. So this is the process. So if ever the auditor wants to do background checks and confirm, he has to be knowledgeable of these functions of the revenue, if ever he's dealing with revenue and the recording of revenue. So he has to inform himself and be knowledgeable, so that when he's going to be auditing the line item here revenue, for example, he will be able to do this. Or when he's going to be dealing with the line item here trade and other receivables. So it comes back to those assertions, coming back from that in bargaining, those components again, linked with those financial statements. So all of this thing, it's one and the same thing. So once you speak about this, you speak about that. Once you speak about this, you speak about that. In the sense that I've depicted it here. So those are the functions. You see, we will have what the audit departments where we receive telephones, emails, system generated, etc., customer orders, and then we do approving, authorizing. So we do authorizing customer, we do authorizing of customer sales. We then afterwards we send back we are going to know we are not going to send there. We are going to go to the warehouse where we are going to be looking at the price of those things that they are ordered. We check that they are available, we check the price, we check what the customer has wanted, and then we issue an invoice again to the customer coming from the order department. We received, we go to the warehouse, we check if ever it's there, and then we say, okay, it's there, everything that this person wants, we then send out, we prepare and issue the customer his or her invoice, which an invoice then will be a detailed explanation of every single thing that is expected the customer should expect to receive, and also a detailed receipt report stating prices and all of that. Sorry for that, but it will be covered. I'll explain it proper again. So these are some of the other things: recording sales and registering, arising, they are raising datas and other activities where we're going to be looking at when bargain goods are returned by customers, all of those things, discounts. So we're going to be looking at the auditor must be able to require all of those things and see how all of these things are actually documented. Please, when these things are here, don't make the mistake of thinking that you are an internal personnel. You are not, you are an external right now. We're looking at this thing from an external perspective. As an auditor, remembering you are interlinking it with what you coming as the person who's trying to come and close in the gap that is created, as in we're continuously going, because now you are coming here trying to know all of these things so that you can gather sufficient appropriate evidence. So when you're going to be talking about relevant hierarchy, you must know all of this information. Okay, so these are the documents being explained proper here. So I think let me just move slowly a bit. Document used in the cycle, customer order, or one, the customer's instruction as to what goods are required. One, this is what an internal sale. So I think also I will you will type also on the, I will also share a link to my WhatsApp, I'll post my number. I'll also share the link. I will try and develop a link and also post my number to this YouTube channel, so that those that are going to want the slides, and the other slides that are going to be used, these are actually written notes that I tabulated for myself to try and make things easy, because for the slides, if ever we're going to be going interchangeably, so through them, we're going to be having a difficulty. So already chapter 2 has been covered, which was covered because of the body. Chapter 5, chapter 10 and 11 is being covered, and then also the same thing will go with inventory, which will be chapter 16 or 17, that I will try and make sure that I make the material available. So these are the informations that you're going to be looking at when we're going to be covering. So right now, remember, this is not a fully fledged tutorial when it comes to the chapter unilaterally, so, or independent. So it being independent. So it's more of an interlink of now, so that we can make you understand. Remember, I said we don't pride ourselves on introduction. We pride ourselves on making complex and difficult modules understandable. So I hope that you are seeing that. For, I don't know, maybe there might be a problem of being unable to transmit or transfer information, but I just so hope that we are on the same page and it all now makes sense. Oh, this is this and this is happening because of that. So yes, we proceed. So these are some of the documents, as I've said. If ever you are going to want this document or the slides, please do contact me on the number that will be written in the description down below, and which will also be linked to the channel somewhere. What else? The links to the channel. We will make sure that we attach the WhatsApp number so that you can just click and then you'll just go to the other side, and then you can also there. So if ever you also want to make personal tutorials, to say if ever, yes, something you did manage to pick up something and you managed to comprehend, but still you are not content, you are not also satisfied, but you feel like the channel is getting you somewhere, and we appreciate at least just making you feel like no, it wasn't as difficult as it is. That's already a mission accomplished for the purpose of this channel. So if ever you would also want to make personal request tutorials respective of where location is, because right now everything is like the tutorial, you are going to be receiving it from a distant geographical location, but you are still going to be linear. So but back to the fruits of the class. We must rush because we are facing the issue of time, because I don't know how long have we been into the session. Audit department, so this is the revenue. So obviously with the revenue, there must be an order department because people are placing orders wanting to purchase from us. So I placed it in the sequence of not, because I started with chapter 11, not chapter 10, because of one reason. I'm explaining this in a form of, it's a cause and effect. It's a folder that is unfolding. So why am I saying? I'm saying basically that we start purchasing because we can't sell what we don't have. So we have to have purchased before that we can sell. Every company, when they start, they must start by purchasing rather than having to supply. What are you supplying if ever you don't have? So I started in that sequence. So don't be surprised with why are you saying chapter 10? And it does not matter. Remember, the numbering of slides is not of great importance, but what's most important is the information and having the information. So this is the order department and the diagram that it is used. Obtain credit approval. We don't just give. So the customer will order depending if ever they are ordering via what they will order online if ever they are ordering online, and then we're going to do an internal sales order where we're going to be checking for all of those things. We're going to look at price listing and all of that. But in that internal sales order, one of the things that they must do, must verify if ever the customer is buying on credit, or the client the customer is purchasing on credit. So there must be information that is going to be required prior the approval or the commencement of the dispatch of the product, the goods. So that's the diagram, and then obviously it will have what its documents, the objective and function. Here they are simply defined, and then when you're going to look at credit application, I made sure that I define those documents is already written there. It's written in an understandable or in an understandable way. So the only thing that you just need is the material, or for the sake of time, if ever, since you have already gathered your material, what you can do actually is to pause the video and then just write the definition as it showed on the screen. But if ever you're struggling when pausing it, things are not showing proper, do not struggle. It's not a train smash, as I've already gave you alternative methods on how to gain access of me and this material. Same goes. Then I wrote, just like with the client's internal control systems for credit approval, the audit process has its own pre-audit requirements. Now we are linking chapter 5 to this. What are we saying actually? We are saying that now, just like with the client's company, once now you are coming to the client and you're going to be talking about the audit department. Remember, when you're going to be doing that chapter, it is very important. Do not go into an examination or into a test without having to have reached this table. This table is the most important thing that you must know when it comes to audit department and all of that. So you must know this table, and this table are different. The first one and the second one, please. Oh, no. They're the same. How did I do it? No, sorry, I did the same table again and again. So you must know this table. You must conscientize yourself to this and familiarize yourself to this table, of which this table is about what? This process on what happens in the order department, because that order, before it comes, we must approve it, or if ever or obtain a credit. If ever they are buying in credit, they must obtain in what they must get a credit approval. So with that being said, in a sense, we also will have an audit. Remember, we are external. We will also have the audit process. The audit process has its pre-audit requirements. Now we are linking chapter 5. Understand and explain the audit process, meaning that we're going to have what we call a pre-engagement activities, or the stages of the audit process overview. The first thing we're going to have a preliminary stage. What is a preliminary stage? A preliminary stage, meaning that before now, the same thing. Let me explain this in detail. When you're going to get there and when you're going to be talking about approval of a credit, you must also think of approval of an audit. So you must use that word. Once you hear approval, it must click into you that there is what we call a preliminary stage to an audit, or a pre-audit requirement. What are pre-audit requirements? Is that we are going to have what we call a preliminary stage, which the preliminary stage is to say before you are going to qualify for an audit. Before you're going to qualify for an audit, you as the client, there are certain requirements that you must meet before you qualify for an audit from the company or the audit firm. So we are going to be looking at a number of those things that are going to be essential to you being permitted the opportunity to actually do what? To actually qualify or be taken. So when we talk about this phase, the first preliminary stage, actually, we are referring to saying, is the client worthy of being entertained by us as what? As the audit firm. So before the auditor will audit the clients, will have to firstly do what we call what? Preliminary engagement activities. Meaning we're going to be doing this. Sorry, let me take this here. On the preliminary, I want to link this preliminary to something else again. You will have these things here. This table here, which will talk to the stage number 1, which is the preliminary, the agreement, the agree terms of engagement. But I don't want that. I want us to focus here. I want us to focus on the preliminary activity, a preliminary engagement activity. When we talk about preliminary engagement activities, we're talking about the things that the auditor will do before entertaining the client. So there will be things or requirements that must be a minimum that the auditor must first gather before he's going to go into the actual information within the company. So what he's going to do, the first thing, he's going to do a precondition of audit. What's a precondition of audit? A precondition of audit, when you are going to think preconditions of audit, I want you to think about the precondition of an audit. I want you to think about an agreement. When you think about a precondition of audit, we are talking about an agreement signed by management which speaks to management acknowledging their responsibilities and understand let me define that. When we talk about preconditions of an audit, the auditor must obtain an agreement of management that management acknowledges and understands its responsibility. Meaning, if ever there is no one who says, yes, I understand, who acknowledges what they were supposed to do and they understand the responsibility, then it means this part, if ever it's declared not obtained, it means that part earlier, the subject matter versus the suitable criteria. No one is saying that I performed that part. When we're looking at the assurance element. So when we have someone failing, the management, the responsible party saying, I don't want you to take accountability and acknowledge that I was supposed to do this duty in alignment with the prescribed bargaining standards, which is IFRS, then the auditor cannot perform an audit. Already on its own, the intended client can hire us as the auditor. But if ever the management do not acknowledge and understand their responsibility, and their responsibility was to classify and document everything in alignment with the prescribed or the suitable criteria, we cannot perform an audit. Because what are we auditing? Because whatever that will be provided in front of us as financial statements, someone is not going to say, I'm the one responsible. So who are we going to be obtaining the information from? Who's going to be supplying us with the information? If ever the management is saying they are declining responsibility and acknowledgement of them having to have prepared the financial statements, and what were they supposed to prepare the financial statements in alignment with, we cannot have an audit taking place. You see, so it will say what? For the bargain, understanding its responsibility for these are the managers, that they must confirm that they acknowledge and understand their responsibility for the preparation and fair presentation of financial statements in accordance with IFRS, GRAP, if ever you're in the public sector, and bargain GAP, which is what? Within the company, appropriate for the company, whichever is appropriate for the company. So this is the first thing that we're going to need for the preconditions. So once we don't have someone accepting and confirming that they are using and they've prepared in alignment with IFRS, GAP, it means we cannot, because these are the acceptable frameworks that we as auditors, we will also be assessing and comparing against the subject matter looking at. So if ever the client is not using any of this prescribed systems or standards, we cannot perform an audit. So it is important for them to acknowledge, because if ever they acknowledge, they are saying that yes, we prepared in alignment with this system. And once we see them not doing what they said they acknowledge, we are going to have a difficulty there. So that's the first point that I want to put out there. So I'm not going to go to these other ones. For this one, we'll say, for each internal control as management deems is necessary to enable the presentation of the preparation of financial statements that are free from material misstatement, whether due to fraud or error. Because now, when they acknowledge, we will have people that will then, because without management, there is no internal control systems that are put in place. So there is the responsible party is very critical. It's very critical in the audit process. So for us to do this thing, remember, for them to qualify, for us to qualify, to start having to say we are doing an audit, we must have received confirmation to them saying that we acknowledge and we take accountability, because we know that when there is management, there are control systems that are going to be in place, that are placed there, that we will be able to actually analyze, do an official inspection over, and examine actually. So I'll not go into depths, but let's stick to the first one that I explained with this one. So when you think preconditions of an audit, you must think an agreement coming from management where they acknowledge and understand their responsibility, which is the preparation of financial statements in alignment with those prescribed financial frameworks or standards, which is IFRS and GRAP and GAP, as outlined, so that they can achieve fair presentations of financial statements. Then second to that, so the first point, the preconditions, was about the agreement, and also that the systems that are it was more fixated on management acknowledging. And then since we know it's okay, management is there, we will then say, okay, it's fine. Prospective clients is number two. Prospective clients and continuation with an existing client. Before accepting a new client, the customer must determine whether they want to venture into this relationship with the customer or the client. Why? To ensure that they do not enter into a relationship that may have a negative consequence to its reputation. The reputation of Cycle, which is the accounting body or the independent body, and also the accountant himself on his profession or his professional profile and record. So these are some of the reasons. So if ever we must examine, it means there are reasons why we would want to and we might not want to enter into this. But the primary one is to say we don't want to enter into a relationship that might have a negative outcome on the image of the company, of the accounting body. A reason why the company may not wish to enter into a relationship with a new unethical or lack of integrity. If ever we are privy to the knowledge that management of this company are known to lack integrity, we cannot associate ourselves with them. Or if ever they are known to participate in activities of unethical conduct, we cannot engage, because it is stated when we are going to do it proper under the chapter 2. It says that if ever the auditor comes across information that is falsified and he's aware, he must recuse himself immediately from the audit he is doing, or that audit engagement he's doing. Why? Because we are not allowed to do anything. We are not allowed to associate ourselves with anything that has to do with unethical conduct, because anything that is unethical will tarnish the reputation or the image of the body and the professional accountant, which is the auditor. So other reasons will be what? The client known for not being able to pay audit fees in the previous company. So one of the things, before we venture into a relationship, we will want to know if ever you had auditors prior, if ever it's not a newly established company, to say that it wants us to start with, we will be the first auditors to work with it. But if ever it has been a giant mogul that has been existing in the industry for a long period of time, oh man, we'll have to ask Uti, why are you changing auditors? What's wrong with the other auditor? So we will have to consult with the previous auditor and say, what is the problem? Then if ever we come across that this company is having difficulty after, when they have to pay the auditor, they don't pay audit fees, we should not get into a friendship or a relationship with them on those reasons. So these are some of the reasons that we are looking at here. And one of the most important thing is that the firm that is to perform an audit must be very competent, meaning that it must have the necessary skill and knowledge of the client who is approaching them and the industry he's operating in. So if ever we don't have experts in our firm that are knowledgeable and well equipped and competent enough to provide the most adequate service, the company will have to recuse itself from that opportunity, because we will not be able to bring out the most possible outcome for the client. So we will come to this other one that says, is the client an evaluation? When we look at the preliminary, will the client be able to be appropriately served now? So we will come across that. So the same goes with this, the same goes for continuing with existing clients. If ever the same principles still apply, but if ever this time around we want to do audit and we start coming under information, we become aware that there is unethical conduct, we might want to terminate our relationship with the client. Terminate contract or relationship if conditions are as above. Maybe one of the conditions is lack of integrity. Compliance with standards. So those standards is that we're talking about integrity of client managers, who are those who are in charge with governance. Once they are known to be participating in things of criminal activities, not bargaining, willingness to pay audit fees, not willing to pay audit fees, reputation yabona is a reputation of a low class, anything that we know that it could have a negative impact to the company, and that violates the integrity of the client's company and the people who are responsible, who are charged with Ntungela, we must not associate ourselves with them. Determine the firm's competency to perform the engagement. The industry knowledge, we must know the industry, have the technical skills to draw out the most possible audit by being able to have the necessary skills, be knowledge of those documents that we were looking at. That's why we say auditing is linking, and the resources, and then comply with ethical requirements, independent and objectivity or objective. What they're saying is that comply with those. For you as an auditor, both the company within it must comply, and also you also as an auditor, you must be able to be independent. No matter what comes your way, be independent. Do not allow your opinion to be clouded by anything. If ever you are feeling that you are under any threat that will threaten your compliance, do communicate it so that it can be addressed. If ever it means they must get a different person to perform the audit, then let it be done so. So another thing that will be done is process to gather preliminary engagement information. What we also need to do is that before we do, there is information gathering that will be done. One, there will be information gathering in doing the audit in doing what the audit engagement, which is what the gathering of sufficient information to form an opinion. This is not the one that they're talking about. Here we're talking about gathering preliminary engagement is about gathering information or requirements to then qualify a client for him to be entertained to qualify for what, for the audit. But when we're talking about audit engagement, we're talking about the gathering of information after this thing here, they have already qualified here. So here we're talking about what the existing client, or let's say, for example, what we are going to want here is to say, if ever it's an existing client, we have already done the preliminary, so it will be easy. Process is easy and readable. Already, bargaining information is available that is readable because we already have the file here, the client. So new client process will become hard for us because why? That person, we still have to do the background checks. So we're going to be looking at this thing. If ever it's a new client, we will have to look at the predecessor audit firms before us. Which audit firm was he working with? And we want to know why is this person not going to that, what left. So we also have to do inquiries, speak with the client's personnel, where we are going to be obtaining that agreement of management, where the management acknowledges. So we are going to also approach them and say, do you agree that you are the managers of this particular company and the statements were prepared by you, and you acknowledge that you were supposed to do them in alignment with this because you are charged with the responsibility of ensuring that financial statements fairly present. Do you agree now? And then if ever they say no, they oppose that, it means we are now unable to proceed with our process. And then we're going to also look at that party. We're going to be looking at lawyers, bankers, and all of that. And then we're going to be doing background checks. Background checks or background research on the internet also will make use, and also public documentation. Let me go into public documentation that are talking about annual reports. So we're going to be also capturing that information and looking at it at there. And one of the most important information is that if ever the customer, the client is not using acceptable frameworks, they will also not qualify. So this is a full breakdown. Let's break down the above more, of which I was saying communication with the previous auditor, discuss with the client's director. So I'm taking all of those things but explain them more proper and all of that, so that you can have an understanding in more depth. So we'll go to number 5. Number 5, we will have to now, if ever all of those things they qualify, now we are going to have what we call an engagement. Now, an engagement, we are going to be establishing an understanding of the terms of reference. Formalization of engagement terms into the engagement letter. Now, once we come to this part here, engagement, once we have done the preliminary, the first one, which is what the preconditions, the determining whether we want to establish with the client, the existing or one, the prospective client, and then the compliance with the standard, and then gathering of information, preliminary engagement information. Then if ever they qualify and we see what no, they have good relations, good reputation, and they don't seem to have anything that could impact us negatively, then we'll then come to the establishing an understanding of the terms of reference. In the terms of reference, what they're just speaking about, actually, we're just saying we're going to now formalize engagements now, and those engagements are going to be in the engagement letter. Those engagements are going to be the audit engagement. That's what they're saying. Now we're talking about the audit engagement, what we have been explaining prior this section. Remember, we came to this section subsequent to the saying that those internal controls, when we're looking at things like credit approval, the client, with the client, there must be an application prior the approval. So same applies with auditing. So when we're talking about the formalization of engagement, they are talking about the audit engagement, because after the audit engagement, what will follow will be assurance engagement, where we'll be providing. So now we're saying that now in the engagements that are to follow, there will be two engagement. The first engagement will be what? Assurance will be what? Audit engagement, because audit engagement is about obtaining sufficient appropriate evidence to form a basis for our opinion, and that evidence will become assurance engagement, because assurance engagement is when we say the professional accountant expresses an opinion which is intended to increase the degree of confidence of the intended user. That's what it goes back to, which now when we're talking about the engagement, the formalizations of the terms of engagement, is that we're going to have the audit engagement and the assurance engagement. And that assurance engagement will be the part where we're giving an opinion, whether it's an unmodified opinion, which means everything is fairly presented, or a modified, which means everything is fine except for a certain particular maybe line item. And then we're going to have an adverse, where we're going to be looking at materiality and what's this thing, sorry, I'll look at that as we continue progressing. Yeah, no, I'll touch that, it's not a problem. I forgot this other term. Yeah, I'll get there. So but for now, the most important thing is that you understand that after all of this thing, now we have formalized. Now the audit part is going to start, and when we're going to start with audit, we're going to have those engagements written in the engagement letter, and the engagement letter is where we're going to be outlining what's going to happen, what is going to be, what we're going to require, where to require it, when to require it, and then we're going to be scheduling meetings. It says all aspects relating to the audit, to the engagement, those engagement that they're talking to, two engagements as of now. When we're talking about two engagements or three engagements, which will be what? The audit engagement, the a review engagement, and also the assurance engagement. And then we'll also speak about non-assurance, but not at the present moment. So all important aspects relating to the engagement are spelled out in the engagement letter. So engagement letter, it means the auditor will have to tabulate something that will be more like for example, I'll give, this is just an example, but again, an agenda on what is going to go about, how to go about, and all of that. So this is where they're going to be outlining all the important information, visitation, inventory counting, all of those things, speaking, the involvement of the audit team, who's the designated auditor, who's going to be signing off the audit report, and all of that. Why do we have this? Why? To avoid any misunderstanding between the client and the auditor with respect to the audit engagement. For example, the audit engagement will not be done with the intentions of trying to detect fraud, but it is there to say things are done in accordance with the prescribed acceptable financial frameworks or standards. So right now, there is what we call an expectation gap, what the public assumes of auditing and what auditing is, depending also on the types of auditors that we have. So the expectation gaps is that auditors vary, but when people think of auditing, they just sum it up to, no, they are going to detect fraud. No, we are not that. Those are forensic auditors who are there to do investigation, to investigate fraud or the likelihood of the occurrence of fraud in a certain body, or it could be issued out by a court or something. But the expectation gap means we then have to explain, to say no, we are not here specializing on fraud detection. We are here to actually clarify the issue of material misstatement, so that any person who's going to be reading the statements of the company, they will be able to say no, this information or the financial statements were verified and audited, to say they were prepared accordingly. And everything that we are seeing, if ever I want to invest, I'm a different shareholder, I want to invest the company, when the importance, don't think that it's meaningless. It's not meaningless to say no. If ever they're not detecting fraud, no. There are people who are interested. So when information or the company has been audited and they say that the net profit, for example, it's 2 billion, 20 billion. That means if ever we are now saying that this is actually what we are seeing, since it has been audited, it is been verified that it is true what the company is claiming, or what the company is claiming is not true. So this then it becomes an advantage and a disadvantage. So if ever it's a disadvantage, the person who's responsible will have to face consequence, which is number 3 of the reasons why we need auditors. And then if ever that's not the case, it means the person then is doing their job proper, and then that will advantage the company, to say if ever there are prospective investors, they will be more motivated to invest. Because why? It has been verified by the auditor, who is independent and does not provide a biased opinion, that the company is actually doing well as it is showing, or it is not performing well as it is showing. So whoever who's interested to take up the opportunity will invest in that. So the expectation gap, or to this is what they're saying, to say we must have this letter which will explain the roles of the auditor and the limitations of an auditor, to say I'm coming as a registered auditor and the limitations that I face are this, and the expectations that maybe you might have from the general public is that me as an auditor, I'm here to detect fraud. No. You are actually calling an auditor, but the wrong auditor. For I am not a forensic auditor, I am a registered auditor. Same applies with an internal auditor. He is not expected to do to provide an opinion to enhance the degree of what the intended users, but his opinion is intended for what? The board of directors. So it then varies there. Hence, then we have to have such tutorials to educate people, and we also have special purpose, but we will cover all of those auditors, not at the moment. Let me not deviate or fall astray from the objective, of which is to give a link to everything. Then that objective, that engagement letter will have this content. They will have this contents in that engagement letter, where we will be talking about the objective. What are we actually hoping to achieve? So the auditor will then express and say, no, the objective of me is to gather sufficient information to form a basis to then give an opinion, and then that opinion will come forward will give out or dish out what? Assurance, which will be reasonable assurance, limited assurance, or absolute assurance, which we will touch, but not at the moment. So the objectives of the audit should be clearly stated, e.g., to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement. Meaning with the materials that we have, as in I've said, what I was explaining, when you do that, we are just trying to prove or to get to a point whereby we're telling the intended user that no, everything is recorded fine, everything was done in alignment with the prescribed, which is the subject matter versus the suitable criteria. And then we're going to have what we call the scope of the audit, which means this is where we're saying the auditor is saying will outline, given the nature of the company, we're still interlinking everything. Given the nature of the company, I will be looking at this line item. I am going to be focusing mainly on revenue. So the auditor will not audit everything. The auditor does not do everything. He will do what we call sampling. So he's going to be doing what? Sampling. So he's not going to be doing everything. So he's going to say that this is what I am going to be looking at. I'll be looking at part A, part B, part C, and part D, not F and H and so on. So all of these things, my opinion will be based on this, and I've gathered material from page 1 to page this. So this opinion, why we're saying it's reasonable? We're saying it's reasonable because why? The auditor will express an opinion on a limited number of line items or a certain line items which goes with its assertions and all of those documents that we have already went through and all of that. So what he's going to do, that person, what he's gonna do is what? He's going to actually what? Do sampling, and that sampling, sorry for the change in Venek. The sampling that he's going to be doing, the scope is just simply saying that this is what I'm covering, and I'm covering this to this. I looked at page what and page what. Based off this, I can conclude that this is what's happening, but it has to be sufficient and appropriate evidence. We still link everything back so that this information does not die. You start knowing auditing. You then can make up sense of auditing. And then the auditor will come back in the city and say, my responsibility are this, not this and that. So he will say, as an external auditor, I'm not of the responsibility of fraud detection. But as a professional person under a certain body, I am also encouraged to have what we call professional skepticism and professional judgment. I am continuously also re-including these names or these two terminologies. The responsibilities of the auditor include an explanation that because of the inherent limitations of audit, together with the limitations of internal control, there is an inevitable risk that, or an unavoidable and inevitable, same thing, risk that some material misstatement may remain undetected. As in I've already said, he might even on the ones that he might look or inspect, there might be a possibility that some of the things might go unnoticed. But let's say also in reality, since I'm saying he's going to be doing sampling, the auditor cannot provide an absolute. An absolute means we have checked everything A up to Z, and we don't have time for that because we use these financial statements need to be published and all of that. So we have limited time that the auditor has to work under. So with that being said, it means we cannot cover everything. So we will only have limited, which is for review engagement, and then we'll have reasonable assurance, which will be based off what he's seeing, based on what the scope. And then he's going to say that no, I've looked at this, and due to this the scope of the ones that he's not covering, it is only just reasonable to say based off this information that, sorry, that that this is the situation at hand based off the ones that he's going to select. And remember, he's going to select them looking at as certain conditions, not being told what to do as though from the directors. So those are the responsibilities. You may also see a clear statement that, okay, all of those things, I'm not going to dive deep into this. We still have things that we need to cover. So these are the responsibilities of what? Management. So this is where the management must go. The management the responsibilities of management must also be outlined in the coming back to what governance and acknowledgement and understanding that they are responsible for the following: the preparation and fair presentation of financial statements. They are going to be needed. So already, if ever they are not agreeing, then it means, you see, that's why we cannot have that. So before that audit could happen, this is why we need the pre-engagement. So then we're also going to have a reference. So we're going to say to the intended users that in conclusion, here, when we're going to conclude, we will say that in our opinion, this is what is going to happen. So the reference is to say that we are going to refer. This is where they're going to outline and say, no, reference to the bargain expected form and content of any reports to be issued. So if ever there's any bargain, they are going to tell in the engagement letter, they are just simply saying that anything that is going to come from us, expect that it will be formed, and any of the reports in that will be issued by the auditor will say what in our opinion, Kamuko. We expect that the report, for example, let me read it proper. Reference to the expected form and content of any reports to the to be issued by the auditor. E.g., we expect that the report to be issued will state that, in our opinion, the financial statements present fairly in all material respect, that financial position of the company at reporting period, the reporting date. So this is what they're just simply saying, basically. They are forming a ground of reference to say, for this to be legit, and at the end, we will say that in our opinion, the opinion must speak to the fairness of all material, or if not, they will also state in the reference. And then in the same engagement letter, they have to speak about what the auditor's the auditor's expectation of written confirmation of oral representation. So he's going to, I'll explain this proper when we're going to be doing this chapter. Proper arrangements regarding the planning and performing of the audit, where they're just talking about the name of the designated person. So what's going to happen is that we're going to have an audit team. That audit team, the auditor cannot do everything unilaterally or himself, all by himself, and go through all of this financial information. So remember, they will be dealing with mogul companies, big companies, a lot of them that get audited. They're big companies. Some have a lot, close to 4,000 plus. Let's say you're auditing Apple as a company, or you're auditing Huawei as a company, or Samsung as a company. How many, or ShopRite as a company, how many employees do they have? Let me just stick to those phone industries where they're doing manufacturing. How many employees do they have under their banner? A lot of employees. So same applies with the audit engagement. The audit. So the auditor will have his own audit panel or team that he's going to be working with, but we will need the name of the designated auditor, which is the registered auditor, who has a CA, who will be the one to write off the report. So he's going to have to reevaluate what his teammates or his panel is saying, or his group is saying, assisting him, and then they're going to do all of these things for the sake of time, and then he's the one who has to finalize and write it off. So we're going to need then Tungela, and then important dates for meetings with key personnel. They're going to do inventory counting, which is audit engagement, because they are gathering evidence. So he's going to be doing that. So it depends whether it will come in the form of a hierarchy, whether he's going to be there physically supervising when they are actually taking this information. Okay. I'll get back to the engagement letter. I've already covered a lot from the engagement letter. And then this is what is going to happen. Okay, fine. So we're going to be talking about what? The testing. So there's going to be testing. Those testings will be done. And then types of audit procedures to obtain audit evidence. Which now we are already, as I've already said there. So these are some of the types of ways information will be gathered or found. We'll be doing what? Inspections. And then you look at the examining records or documentation. And then we'll be doing observations. We are going to be looking at a process. So the auditor will arrange meeting as outlined there in the engagement letter, where he's going to come and say, no, I'm going to be present. He might be doing an observation, looking at how they do certain things, how they record, or how certain, all of those things. I'll cover everything in deep or recalculation, where they will be doing our inventory count and all of that, where they will be asking, where they will be calling maybe customers and all of that. So I just had to take randomly from there and just explain. And then these are the classes of the transactions assertions as assertions per class of transactions. Sorry, I'm just starting to become tired a little bit, Lisa, for that. Okay, I ended it here in terms of making the notes. Where is chapter 5? Okay, this is chapter 5. Now, with all of that being said, after the preliminary has ended and they've tabulated the engagement letter and whatnot, and then we're going to go to the second stage, which is what? Stage 2, the planning, which there it also includes that engagement letter, da 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 da, the drafting, the planning, the planning on how to obtain evidence, when those meetings, as stipulated in the engagement letter, those deadlines and everything, when are they going to come to do citations to the client's company and all of that. Depending on the complexity of the client's company. And depending on the client's company, so, and how they are going to be gathering information and when the auditor will be coming and how is information going to be required and obtained and all of that, and how should the management behave as in prescribed in their responsibility and the responsibilities of the auditor, and him explaining what are his responsibilities and what he's there to do and explaining that. So we're going to the planning, as I've already said, he's going to be doing that as I'm explaining. Then we come here and then we have to explain that if ever there's planning, why should they be planning? Why should they be all this planning? So we have to now know the importance of planning. So this is the importance. The importance of planning cannot be overemphasized. Proper planning helps to ensure that appropriate attention is devoted to important areas of the audit, e.g., significant risk are identified and addressed. So right now, what we're going to do, so we look at the nature of the company, and then we spot areas that have the highest probable likelihood of risk or material misstatement happening there. Then we are saying that, oh, because now we had the opportunity to plan, we can then focus our energy here. Let's say then we have that panel, the designated auditor with his panel. Then they say, okay, we managed to do this line item and this line item, but this line item, it shows that it has high risk of material misstatement. So then they can focus their energy and devote it into that important area if ever it's significant. And then they focus their attention there to identify those risks, because the risk when they happen, normally they result as a material misstatement, whether as a result of falsification or deliberate attempts or by mistake. So, and then we address that. Potential problems are identified and resolved at a timely basis. So I'm not going to continue, but I think let me just read one that is most important. A competent and capable audit team can be formed hour. So we need planning so that we can look at the magnitude or the scale of the company and its complexity and say how many people, what the audit team should comprise of how much of individuals to help us achieve the audit deadline and to submit the audit report at the time that is allocated in the audit engagement. So hence, this is very important. A competent and capable audit team, including other parties, e.g. experts and other auditors who may be required on the audit. One, work can be appropriately assigned to audit team members so that the audit is effectively and efficiently performed. Audit deadlines are met. So that's the primary reasons why we need to do an audit planning before we do an audit engagement. So we are going to have what? An audit strategy, which will be looking at the scope to say at this particular time, it sets out the scope to say this is what we're going to focus on in alignment with the importance of what audit. And then we're going to be looking at the timing. When are they giving this, and then when is it expected to and direction, given the nature, where should we look at, which are the primary key place or points to actually focus on, and the development of an audit plan. So we're going to be looking at that. So that's the importance of what the importance of planning, of the bargain planning stage to develop an audit plan. So they are going to be looking at this. So we're going to have what we call an overview audit strategy with it sets the following: the scope, the time, direction, and what the guides development of the audit plan. Ascertain the resource necessary to perform. Then we have to also look at what we are going to need. As in I've already said there, when we are looking at competency and capable, to form a competent and capable audit team. So it means we will also have to look at what resources necessary to perform, the number of people, meaning that the resource to be allocated, the number of people to be allocated to specific audit areas, the level of staff, experience required, use of experts, the amount of resource to be allocated, the number of staff. So you are looking at it from an external perspective for a call. Don't forget that. So always when you speak about auditing, remember where I am and how this thing is continuously speaking to each other. So we come back to what? To characteristics of an sorry, let me move this a bit. The characteristics of an engagement which define its scope. So we're going to look at the financial reporting standards on which the financial information to be audited has been prepared. So when we're going to be looking at the scope, the characteristics of the engagement coming from the preliminary, we have to assess the system they're using. Are they using Grab or IFRIS? So that when we approach knowing that these financial statements were prepared and we're going to audit them, looking at which suitable criteria. Is it the IFRIS criteria or the Grab criteria? So that's what they are just simply saying. And then that will determine the scope, because the scope is what we're going to be covering and what we're going to be focusing on. So whatever that we're going to be focusing on, it has to have its own suitable criteria that will be looking at and Twingela. The need for specialized knowledge of the client's industry. So we will have to, so the scope also was able to know based on the nature and extent of the company. We will look at the client's industry, and then from there, the scope, or meaning that the scope, which will be the areas that will be covered, we will be covering them based of the nature of what, of the client's industry, to say, oh, okay, since I said, for example, I gave an example with the vehicle, or when you are a car dealership, when you have cars, it's not a thing which would even want to really focus on inventory and having to thoroughly check there. So such things also determine the scope. So the engagement on the preliminary then will also speak to the scope or define the scope. Bon, nazo-ke. And then we'll have what matters that will affect the reporting objectives, timing of the engagement, and nature of communication. The company's timetable for reporting. Is it reporting within interim, meaning is it reporting half of the year, 6 months, or is it reporting at a 12 months period? So we want to also know, it's very important that in our engagement, that when we're engaging this company, we have to understand what we're consolidating for what amount of period, because the larger the period, the more requirements of resource will be needed in terms or in alignment with the scope and what the planning, which will also lead to the audit plan. So we have to look at the timetable of the company, and then we also have to look at the size, complexity of what the clients. The bargain. Let me read it proper so that you can see it. Exactly. The size, the complexity, and number of location of the client. So if ever the client has a number, quite a plethora of shops across that maybe have that are being audited. If ever we're going to be going to them, that's also going to be affecting our time. So it means if ever we're making time and we want to make the most realistical reporting deadlines for the opinion to be served, we have to look at the complexity and the locations. If ever we're going to be doing site visitations and all of that, to do those analytics, those observations, using those types of gathering of the types of audit procedures together information or to obtain. So this is also going to be looking at that. That's why they're saying that timing and the reporting objectives. So when are we expecting or aspiring to file in or submit a report? So we will have to look at all of those things, the duration and all of that, but I will dissect it further when the time comes for me to deal with this thing proper. So one thing to know, the audit plan itself is closely interlinked to the audit strategy. Remember, we strategize based on the nature of the environment. And then after we strategize, we look at it, okay, the strategy is to say, given the size, the type, the nature of this company, this is how we're going to do. I think we would allocate 5 people, or we'll have a panel of 10 people, exclusive of the designated or inclusive of the designated auditor. Then that's a strategy. And that strategy then will then start drawing an audit plan on top of that strategy. Hence, it says the audit plan itself is closely interlinked to the strategy or the audit strategy, which was already defined there, which is the scope, the timing, the direction, and also guides the development of the audit plan. So it's then the audit plan, it's a more detailed, because strategy is say, okay, this is what we're going to do, that's what we're going to do, but it does not thoroughly or detail everything proper in more detailed. Sorry, English just disappeared for a moment. My English bundles are running out now. So this is what we are looking at when it comes to the audit plan. So it's very important to know that that's the key information. And then you just have to know the description of the nature, timing, and extent of the planned risk assessment procedure. So all of those things will be based off the nature and everything. But I've already explained these things, that just that more you just need to have more detailed information. And then this is still the continuing, you see, still at the end of the day, you see, still the same thing, same information, examples to discuss, concepts above. And then we talk about this thing now, material. So this is very important to say, when we're going to be doing the audit, what is deemed a right or admittable as what material. What is material and what's materiality? What do we consider to be considered material and what's not material? So we're going to be looking at that also, but as in right now I was interlinking this. So this is what we're talking about when we're talking about the audit procedure. So now when we want to gather, we want to, so we are linking now chapter 5, as in now I don't want to, because I feel like I'm bombarding you guys with information too much. But that sequence with materiality, let me just maintain that definition and let this be. Materiality speaks to what's credible, to what makes significant impact and what does not make significant impact, to with regards to the performance and the report to be submitted. If ever there's 1 rand missing, that will be regarded as immaterial. But if ever there's 1 million missing, that will be regarded as material. So materiality speaks to anything that that holds significance or will be regarded as being not significant to the purpose of the audit. Planning and conducting risk assessment. So they are going to evaluate that, and then the evaluation will be done at risk at financial statements level, risk at assertion level. So we will look at financial statements as a whole, or we'll be looking at transaction unilaterally as a class of transaction. Remember, the financial statement is a sum total of all transactions that are happening on a daily basis within the company. So don't be confused with, oh no, this guy said no. Assertions are within financial statements. Remember, financial statements, assertions are a class of transaction, a class assertion per class of transaction. But when we talk about a risk at financial statement level, so what could be the mistakes that could happen at a financial statement level, and what could be the state mistakes that could happen at a class of transaction? Remember, in accounting we have what we call working the subsidiary journals, general ledger, general journal, and then all of this information is going to be transferred to the annual statements, which are the financial statements. So there also could be a contradictory between the transfer of this data. It may be recorded proper in the journals, the general ledger, but now the problem was that when posting it to, so we have to assess the risk there on that Ntunyela. And then if ever there is a contradiction between figures that are there, we have to also do an investigation or a checking or a follow-up on why is there a difference. So this is where they define it proper, or where it's defined in detail, but I've already explained it as in what is assertion at a risk and assertion at a financial level, at a financial statement level, and where the issue could arise from. So, and then we will have what we call planning further audit procedure based on the risk assessment, testing of control, seeing that the internal controls that are placed, which we are going to make an opinion based off the information that is coming from them. Are they strong now? How credible are they? How reliable are they? So we have to do a test of control. But it is also important that not all systems are worthy of being tested. So we are going to have what subsequent testing, which is a follow-up testing after doing the prior testing, but I'll dive more into that. Some general actually no. This one is not important for now. Strong environment. That's the sufficient. No, responding. So this is responding at a bargaining stage number 3, which is responding to the assessed risk that we might have discovered in the process. Sorry, I've been sitting for quite a time.